There's a secret most people never learn until it's too late. Not because the information is hidden behind a vault, not because it's classified, but because if everyday people truly understood how financial crashes form, they wouldn't be the ones left holding the bag. Here's the truth. Every major market crash of the last 100 years follows the same pattern. Not a similar pattern, not kind of the same. The same 5-stage sequence, repeating like a script, sometimes slowly over years, sometimes quickly in months. 1929 followed it, 1987 followed it, 2000 followed it, 2008 followed it. And when people finally realize what's happening, it's always the same story. They say, how could this happen? They say, nobody warned us. They say, this came out of nowhere. But it didn't come out of nowhere. The warning signs were there the whole time. The real tragedy is that most people don't learn the signs until after the damage is done, after retirement accounts collapse, after layoffs surge, after credit dries up, after families are forced to sell at the worst possible time. And that's what makes this so personal, because this isn't just about markets. This is about your life, your paycheck, your rent, your mortgage, your retirement, your ability to breathe without financial stress. So today, we're going to walk through the 5 stages. And by the end, you'll see something most Americans still don't. You'll see where we are right now. And you may realize it's something uncomfortable. We're further along than most people think. Don't forget to click on that subscribe button and like this video, as it's the best way to support this channel. Why crashes don't just happen. Most people think crashes happen because investors panic, or because a big company collapses, or because something shocking happens on the news. But that's not what causes a crash. That's what triggers the crash. A crash is like a building collapse. A building doesn't fall because of one small shake. It falls because the beams were weak, the foundation was cracked, and the structure was overloaded. The shake just exposes what was already fragile. In financial markets, it works the same way. Crashes aren't random events, they are structural failures. And the structure fails in stages. That's what makes this so dangerous. Because during stages 1, 2, 3, and even 4, everything still looks fine. The headlines remain confident. The charts still look strong. The experts still smile on TV, and regular people are still told to relax. Long-term investing always wins. But behind the curtain, the foundations are cracking, quietly, mathematically, inevitably. The man who warned Wall Street and got mocked for it. In 1929, there was a man named Roger Babson. He wasn't just some doomsday blogger. He wasn't trying to sell fear. He was respected, known, established. But he said 9 words that instantly turned him into Wall Street's enemy. Sooner or later, a crash is coming, and it may be terrific. People laughed. Newspapers mocked him. The financial elite dismissed him like he was a clown. And the most famous economist in America at the time, Irving Fisher, publicly announced that stocks had reached what he called a permanently high plateau. Translation: this market is not coming down. 47 days later, the market collapsed. Hard, violently, historically. And Fisher, the genius economist, lost everything. He died broke. Babson, meanwhile, didn't just survive, he thrived. Because he wasn't guessing. He had developed a method, a framework for identifying when the system was becoming dangerously unstable. He tracked 5 factors: credit expansion, concentration of risk, institutional behavior, liquidity conditions, trigger vulnerabilities. In simpler words, Babson found a crash formula, and when you test his crash formula across history, it holds up, over and over. Like a law of gravity. So let's walk through the 5 stages, one by one. Stage 1, the credit explosion where every crash begins. Every crash begins the same way. Not with fear, not with panic, not with greed, with debt. This is the part most people misunderstand. They assume a crash happens because people got too excited. But excitement is not the fuel. Debt is the fuel. Debt is what turns normal excitement into systemic disaster. Here's why. When credit expands faster than the economy can absorb it, it creates artificial wealth. People borrow money they don't really have. They use that borrowed money to buy assets. Assets rise. People feel richer. And when people feel richer, they borrow more. That's the loop. It feels like prosperity, but it's not prosperity. It's a trap being constructed in slow motion. 1929. Factory workers leveraged like hedge funds. In the late 1920s, normal Americans weren't just buying stocks. They were borrowing to buy stocks with margin loans. Some people were putting down only 10% and borrowing the other 90%. By 1929, total margin debt had exploded. It reached a level so extreme that it equaled the entire federal budget. That means the stock market wasn't rising. It was being inflated by borrowed money. When debt drives prices upward, prices become fragile, because once prices drop slightly, margin calls begin, and forced selling creates more selling, and that creates a waterfall. To a date, mortgages became weapons. In 2007 and 2008, it wasn't margin debt, it was mortgage debt. Banks created innovative loan products that made it possible for people to buy homes with little to no money down. They packaged those mortgages into securities, sold them to pension funds, sold them globally. And suddenly, the entire world was exposed to U.S. housing debt without even knowing it. It wasn't just risky, it was invisible risk. That's why it was so deadly. 2000. Corporate debt disguised as the future. In the dot-com era, it was corporate borrowing. Companies with no profits, no stable customers, and sometimes no real business model borrowed billions for expansion. Stock prices became collateral. The whole game depended on prices never falling. Then prices fell, and the structure imploded. Today, the biggest credit explosion in U.S. history. Now look at today. You can see the debt everywhere. Official margin debt around $750 billion securities. Based lending adds hundreds of billions more options. Markets create trillions in effective exposure. Corporate debt has exploded above $10 trillion. Government debt has crossed $34 trillion. Interest payments are becoming one of the largest line items in the federal budget. And here's the key point. Debt levels relative to GDP are higher now than on 1929-2008, any point in recorded American history. So stage one isn't just active. Stage one is screaming. And when stage one screams long enough, it always creates stage two. Stage two, the concentration trap, the hidden fragility. Most people miss. There's something most people never learn about markets. Crashes don't happen just because prices are high. Crashes happen because risk is concentrated. In other words, when the market becomes dependent on a few assets holding up the entire system, the system becomes fragile. It becomes a table balanced on two legs. One crack and everything collapses. 1929. One stock became the market. Back then, it was glamour stocks. The superstar of the era was RCA, Radio Corporation of America. Radio was revolutionary. People didn't understand it, but they understood this. RCA kept going up, so they bought it. It went from almost nothing to absurd valuations. And because so many people were positioned in the same few names, when RCA cracked, the whole market cracked. 2000, 10 companies carried the NASDAQ. In 2000, it was tech giants and dot-com favorites. A handful of companies carried the market. When those companies rolled over, trillions vanished. 2008, hidden concentration in banks. In 2008, concentration wasn't obvious. It was inside the banking system. A few major banks held massive derivatives exposure. One failure created systemic panic. Today, the concentration is blatant and ignored. This is where it gets terrifying. The top 7 stocks in the S&P 500 have at times accounted for 30% to 35% of the entire index. That means the average American, who thinks they own a diversified 401k, is actually making a massive bet on a handful of megatech stocks. Read that again. Most retirement money is not diversified. It's concentrated. And this is what passive investing has done. Index funds automatically buy more of the biggest companies. That pushes them higher. That increases their weighting, which means the next dollar buys even more of them. It becomes a momentum machine, works beautifully on the way up. But on the way down, it reverses violently. Outflows force selling. Selling hits the biggest positions first. That creates more selling. It becomes a death spiral. Stage 2 is not a theory. Stage 2 is visible in the data. Stage 3, the smart money exit, the most unfair stage. This is the stage that should make you angry, because it reveals how the system really works. Before every major crash, institutions quietly reduce exposure. They raise cash, they buy protection, they reposition. But publicly, they tell you everything is fine, they tell you not to panic, they tell you to stay invested. And while you stay invested, they're moving toward the exits. You become their liquidity. You become the buyer they need. You become the person holding it when they're gone. 1929, the elite sold before the fall, the Morgans, the Rockefellers, the insiders. They began liquidating months before the collapse. Bernard Baruch, one of the richest men alive, was largely in cash by September. Regular Americans kept buying. 2007. Wall Street shorted what it sold. Hedge funds began shorting subprime far ahead of the crash. Banks sold toxic securities to clients while betting against them. Mortgage executives dumped their personal stock while telling investors the business was strong. Regular people kept buying homes. Today, insiders are selling again. Look at modern insider selling. CEOs, CFOs, board members, the people with the best information, many are selling aggressively. Meanwhile, retail investors continue pouring money into markets through 401ks, Robinhood, and passive funds. Smart money sells, retail buys. That's not random. That's stage 3. Stage 4, The liquidity illusion, when everything looks fine but oxygen is leaving. Liquidity is oxygen for markets. When liquidity is strong, prices move smoothly, buyers exist, shocks get absorbed. But when liquidity fades, markets gap. Small selling causes huge drops, panic becomes unavoidable. And here's the trick. Liquidity disappears quietly. The market can still be high while liquidity is collapsing underneath. That's why stage 4 is the sneakiest. In 1929, the Fed tightened and the bids vanished. The Fed raised rates, tightened monetary conditions. At first, nothing happened. The market stayed high. People assumed tightening didn't matter. Then selling began. The bids disappeared. Stocks didn't fall. They dropped into free fall. 2007, 2008. The exact same setup, the Fed raised rates. Credit tightened. Markets stayed up. Then Bear Stearns. Then Lehman. Suddenly, everyone realized liquidity was gone. The crash accelerated. Today, fastest tightening in 40 years. Now look at today. Rates went from near zero to over 5% rapidly. Quantitative tightening pulled money out of the system, but markets still look confident. And people assume that means everything is stable, yet the cracks have already shown. In March 2023, major banks failed in 1 week, and the Fed had to step in with emergency programs. The Treasury market has shown signs of liquidity stress too, and that's the foundation of the global financial system. This is stage 4, calm on the surface, oxygen draining underneath. Stage 5, the trigger, the match that lights the fuse. This is where people get it wrong. They think the trigger causes the crash. It doesn't. The trigger reveals the crash. Stages 1 to 4 build the fragility. Stage 5 is simply the moment something hits the weak structure. In 1929, a British fraud arrest helped spark selling. In 2008, it was Lehman. But it could have been something else. That's the point. When a system is fragile enough, any spark becomes an explosion. So what's the trigger this time? Nobody knows. That's what makes it dangerous. It could be geopolitical escalation, derivatives, failure, regional banking collapse, commercial real estate, shock, political dysfunction, sovereign debt, panic, or something nobody sees coming. Because the trigger is rarely the thing everyone is watching. It's usually the thing nobody expected. What this means for you, the part nobody explains clearly. Let's make this real, because this isn't about charts. It's about consequences. If markets fell 50% like 2008, the impact wouldn't just be investors lose money, it would hit retirement accounts, hiring plans, wages, small businesses, real estate prices, consumer confidence, credit availability, layoffs and unemployment. That affects groceries. That affects rent. That affects your job security. That affects whether you can refinance, whether your kid's future gets delayed, whether you're forced to sell in panic. And that's why this matters, because most people don't get wiped out in crashes because they're dumb. They get wiped out because they're unprepared. They trust that the system will protect them. They assume someone will warn them. But history says something brutal. Nobody warns you, or worse, they reassure you, right up until the fall. The Babson versus Fisher lesson and why it's so important. Roger Babson wasn't smarter than Irving Fisher. Fisher might have been the smarter man, but Babson did something Fisher didn't. He respected the pattern. He positioned himself for what was coming, not for what he wished would happen. When everyone else was leveraged, Babson held cash. When everyone else bought the top, Babson moved into resilient assets. Fisher mocked him. Fisher lost everything. Babson built a legacy. And that's the choice every era forces on regular people. Believe comfort or understand reality. The real question isn't, will there be a crash? The question isn't, is a crash coming tomorrow? Nobody can time that. Anyone who claims they can is lying. Markets can stay irrational longer than you can stay solvent. The real question is, are the conditions present? And based on this 5-stage framework, they are. Debt is extreme, concentration is extreme. Smart money behavior is flashing warnings. Liquidity is tightening. Triggers are unknowable, but vulnerability is obvious. So the question becomes, what are you going to do with this knowledge? Not panic, not hide in a bunker, not sell everything, but ask better questions. How concentrated is your retirement exposure? How dependent are you on mega cap tech staying perfect? How vulnerable are you if credit tightens? How long could you survive a recession job market? If your assets drop 40, 50%, do your plans collapse? That's not fear. That's adult thinking. That's preparedness. That's survival. Final thought. The pattern is the warning. In every crash, people say, nobody saw it coming. But the truth is, people saw it coming. They just didn't want to. The signals were there. The pattern was there. And the people who win through crashes aren't the ones who predict the exact day. They're the ones who recognize the sequence early enough to stop being exit liquidity. And now you know the sequence. Now you know the pattern. Now you can see the warning. And that alone puts you ahead of most people. Because in financial history, The most expensive mistake is believing this time is different.